Welcome back to the ET Money Show. And as we kickstart a fresh year, several uncertainties and the global factors continue to impact the equity markets in India and abroad as well. And given the recent market volatility, perhaps it makes sense to invest in multi-asset class funds. So that is the question that we are going to ask from our experts. And the next question that we have is that should they be preferred option for your investment for the whole year of 2023? And to answer all of these and discuss more about the multi-asset class category, let's bring on board Lakshmi Iyer, who is the CEO of Kotak Investment Advisors. Lakshmi, a very good evening. Thank you so much for joining us today on ET Now. Pleasure having you.
Hi, good evening. Thanks for having me over.
Lakshmi, before I come to asking you a question, are you in the preference or are you in the favor of having a multi-asset class in 2023? I want to help my viewers have an understanding on the returns that we have got in 2022. Like if I say the equity markets were almost muted because of the kind of great returns that we have seen in the past, for 2022, that was all about the sectors and some of the stocks performing. Debt was also muted, although the gold have shown very much, and that was very interesting to know that the shine is continuing even in 2023, and real estate also fared better. So what is your view that 2023 in terms of volatility and the disparity in terms of return in all of these asset classes, how 2023 going to be?
Hi, so your observation is bang on, and it's maybe in 2022, some bit of this got exaggerated given the dollar rupee movement, for example, because if you look at gold, since you started off, I'll start off with gold. If you look at gold, if you look at the rupee returns for the investor, it was hugely in the positive. It was in the vicinity of 13% for the year. Whereas if you look at the dollar return for gold, it was very similar to what probably a fixed income, moderate duration fund would have returned. So I think 2022 was a couple of, I would say, things panned out. One is you saw relentless rate hikes across the globe with a view to combat inflation. And because of that, if you look at the fixed income returns range, for 2022, it was lower end of say 1.5% to the higher end of about 4.5%. The interesting thing to note is that these categories actually did not return negative, despite the fact that we saw the yields move up quite relentlessly. Moving into 2023, I think a couple of things, again, we need to keep in mind that asset class rotations are inevitable, whether you were 2 years back, 3 years back, or you go 1 year, 2 year, 3 years hence. And hence, to have a reasonably well-rounded portfolio, keeping most importantly your risk appetite in mind and your longevity is inevitable. So I would say that the role of asset allocator funds and the right kind of asset allocation assumes even more renewed significance as we are almost plateauing out on interest rates, but the vulnerability from the global front continues to persist.
Very well said that we don't feel that we are still out of the woods, but the question that we are asking today for all our viewers is that the multi-asset class category, will you go and vouch for that 2023 could be the year for all of these categories, clubbing all of these assets in one and expecting returns out of that? And can this asset class and fund category give better returns than investing individually?
If you look at the past 12 months, certainly the multi-asset category has demonstrated mettle. Predominantly, if you see, this category comprises equity, fixed income, and gold in varying proportions. Clearly, gold has been the winner of the year as far as 2022 is concerned, followed by equities and fixed income in varying combinations. Looks like given where we are from a macro perspective, given the fact that on a risk reward base, I would say precious metals like gold continue to retain its sheen or shine, multi-asset allocator funds could be a very good complementing strategy to your current asset allocation portfolio. So whether we are talking about just the year 2023, I would say don't plan it only from a 1 year perspective, but looks like this could be a theme given the kind of effervescence that we are seeing and the pace at which these categories are moving. So you're better off leaving it to these category funds to be able to play that role, at least in a tail-ended allocation to your portfolio.
Lakshmi, get that point that you are in favor of these multi-asset class, but you are still making a point that it could be a good complementing fund category. So if I have around 100 rupees, what will be your advice that in that, how much you can actually look to divert for this particular category?
So, two parts to your question or two ways to answer your question. If my appetite for risk is still reasonably high, on a 100 rupee portfolio, I would still prefer to be allocated higher towards equities and say to the tune of maybe 65 to 70%. And the remainder portion could be a combination of both. Fixed income as well as the multi-asset allocator funds. Whereas if my risk appetite is quite conservative, I would still have, I would say, more than 80-85% of my portfolio in fixed income, which is where we seem to be trending as far as 2023 is concerned, except if you give it for a year's time. And the tail end allocation of 10 to 15% should still go into these multi-asset allocator strategies. The advantage, I'll tell you, is that the combination of three asset classes blended into one allow you to give a nice cue to your, or even pull up the returns of the predominant asset class, depending on whether it's fixed income or equities, when the chips are low for one of these asset classes. And that's something which we saw play out phenomenally well, especially in the last year.
Okay, totally get your point, and thank you so much for that bifurcation and helping the viewers understand what they should actually do regarding their risk appetite. But Lakshmi, with investing over the last 12 months or so, one of the major concerns was actually inflation. They were actually looking to invest in such asset category which can actually beat their inflation for say 6% and above. But sadly, some of the asset classes didn't perform really well, like you were also mentioning. But going ahead in 2023, do you feel that multi-asset class, because with inflation, different categories react differently, this can prove to be a portfolio or an investment which can be inflation proof?
So if you look at within the multi-asset category, which have demonstrated their mettle as an inflation fighter or an inflation solution provider, clearly equities stand tall and followed by gold. Fixed income seldom has the agility or the ability to outperform inflation on a consistent basis. It could be tactical, of course. So hence, my view would be to look at it from a holistic perspective. There could be pockets, even in equity as an asset class, the way we saw last year, its ability to fight inflation or beat inflation, especially when inflation is moving at a faster pace, clearly gets restricted. But if you look at on a larger canvas over a 3 to 5 year horizon, we've seen time and again and consistently inflation beater asset class continues to be equity. So yes, if you also have that in mind and you believe that I don't really want to expose my portfolio predominantly to only one asset class, please feel free to go and use the multi-asset allocator way of allocating money, because you get, as I said, all in one, and the potential of even if two asset classes perform better than the third one, that itself takes you a bump up as far as the inflation is concerned.
Okay, Lakshmi, just wanting to understand that how beneficial are these when it comes to the tax aspect, because all of these different asset classes have different tax methodology, but when we are clubbing all these asset classes in one, so does investors have some kind of a tax saving investing in these portfolios?
See, only if the portfolio is predominantly equity, do you have the equity taxation, which in this case is greater than 1 year, qualifies for long-term capital gains. Every other category right now actually qualifies for the fixed income taxation, which means the long-term capital gains actually kicks in after 3 years.
I have a couple of questions, but let me just club into one, because what I'm understanding is that the preference is still into equity. So if one has to select a multi-asset category fund, what kind of bifurcation or investment he should be looking out for? Because in this category, at least 10% of the investment in 3 different funds or asset classes has to be there. So the preference should be for one fund which has more diversification or more inclination towards the equity class. And secondly, wanted to know that if somebody is looking to invest now, what should be the preferred way of investing, an SIP or a lump sum?
Your question, when you are looking at a multi-asset allocator, one needs to be mindful whether you're picking up a very dynamic multi-asset allocator or a reasonably static with a minimum mandatory and a top-up. So these are the 2 key things. Typically, we have seen that most multi-asset allocators have a reasonable high skew towards equity as an asset class over and above the mandatory requirement, given the fact that these are not categories which are recommended from a 1-year perspective. Yes, you could initiate your investments basis your view, but typically even these are investments which play out its full metal over the 3-year horizon. So certainly look out for the category within this which has a skew towards equity and does allow you to participate in reasonable quantum towards gold and fixed income. On your second part, whether it should be SIP or STP, given where we are in terms of markets, if you are doing a multi-asset kind of a strategy, you're okay to do a lump sum even right now, or at best an STP where you put a lump sum into an overnight liquid ultra short-term fund and you grade your entry into such categories over the next couple of quarters, given the wobbliness of the market. That could be one way out. But yes, if you are still preferring a diversified equity fund route, then you're better off doing a combination of SIP plus STP only right now.
Okay, totally take your point. With this, we'll let you go on that. Thank you so much, Lakshmi, for coming time and again and helping our viewers to have a better understanding on their investments. Because last week, I remember we had you on the debt outlook for 2023, where your preference was to invest in the medium term category of the debt investment. And today is multi-asset class should be your preferred bet for 2023. Thank you so much for that, Lakshmi.
Thank you.